Hey everyone, it's Imran back again with the macro options spotlight. All right, US stocks under pressure yesterday. No breakthrough on the debt ceiling as you'd expect, but we did get some US-China tensions ramping up due to them banning Micron, and the US talking about retaliation to China. So that's not a great thing for a headline, and that sent China lower and is generally weighing on markets. Europe has also been weak. The luxury sector getting battered. LVMH, big stock that's been performing spectacularly, right? As well as any of these kind of tech stocks as well, was down 5% in a day, wiping out a couple of months of performance on slowing sales. There was a conference in Paris where it was mentioned, and that was not good for the stock. So Europe just generally pulling back. It's obviously been very firm, Europe, on a relative basis. So we might be starting to see the first signs of Europe having a meaningful pullback. Gold did outperform the other metals yesterday. So industrial metals a bit weaker. Silver also, miners also, but gold itself managing to hang in there and be small green on the day. We saw nat gas continuing to slide, hasn't really managed to hold on to that rally, but oil itself has steadied. We had a surprise draw down in crude inventories. And obviously, we mentioned what the Saudi finance minister has been saying about shorts, be careful. So those sort of things are kind of helping oil firm up in the near term. The dollar's still strong, but remains in an orderly sort of ascent, nothing too violent so far. But in general, you're seeing euro weak. Sterling was a bit weaker as well. And Aussie also weaker, tends to be quite correlated with China. Okay, skew wise, equity skew recovering. You can see here, 3/4 of a vol in a day is a pretty decent bounce. Back to that 68th percentile area. So skew looking quite pumped yet again. No surprise, we had said we didn't think this debt ceiling stuff was going to go away this week. So that's back where it was. VVIX also pretty well bid, regaining the 100 level. You can see that here in this skew measure that we see on the VIX, showing that call skew on the VIX is pretty steep. There has been a fair amount of call buying activity going on the VIX in June, July, September, things like that. Commodities skew was fairly mixed, nothing too clear to say. Bond skew, did see put skew firmer in bonds. Obviously, yields have been pushing higher. Bonds have been selling off, even though we're not really moving very fast. It's a little bit of nervousness coming back there and seeing puts go a bit firmer. And then sector skew, finding a bid across most sectors, except for ARC, which is still softer, down to a 6 handle. That's on the 10th percentile for ARC skew, which is basically people starting to cotton onto the idea that the upside in ARC was looking a little bit cheap because there may be a bit of a breakout to the upside coming at some point. Okay, implied vol and carry, stocks vol bouncing, seeing over a vol point here in the major equity indices as nerves come back. And the street tends to be a bit less long vol. Obviously, they had a load of gamma last week that expired. Now that we've popped our head below 4150 on the S&P, books have kind of flipped a bit shorter. So it makes sense that vol should catch a bit of a bid in that outcome. Commodity-wise, metals vol seeing a bit of a pickup. Nat gas vol fading down 2 points as the rally couldn't hold. And the FX vols are fairly unchanged. We did see HYG vol firming up, though, on high yield as it was down 1 standard deviation, down 50 basis points on the day, along with the general risk-off tone. And then if we look at carry, still holding green for most equity indices except for China. But we think that might well evaporate pretty quickly if things start to escalate on the downside. You might suddenly see all this green disappear very fast in like a day or two. And then carry conditions outside of equities remain pretty much the same as they were. As we said, FX fairly neutral, bonds pretty positive, healthcare pretty positive as well there. That's where the most juice is. And then obviously you've got precious metals giving you a bit of positive versus other commodities in the red. All right, so that's the summary for where we are. Looking on at what charts have kind of caught my eye. So Bank of America last week put out some data showing significant drop in US household spending. They were down 1.2% year on year. first time since February 2021. Okay, so look at 2 years, first time in 2 years. The decline was driven by high income households. And also we're seeing their after-tax wages of that bracket contracting as well. Okay, and that was down for a second consecutive month. So this challenges the Fed's belief that wages are rising in the mid 4% annual pace when you've got those higher income part of the spectrum actually not seeing anything like that. They're contracting. Okay. Moreover, small businesses are experiencing a dramatic deterioration as well. Business sentiment has dropped down to the lowest reading since January 2013. So looking at 10 years. Falling sentiment in businesses leads to reduced spending, and they pull back on capex and hiring. Okay, so these are all pretty poor leading indicators for what we're looking at going forward. Now, Bank of America, to get a handle on this, or to see the internals, they look at their card data, shows that total payments from small businesses are contracting as well. The real estate and the wholesale trade sectors are the worst hit in terms of the slowdown. They're seeing the largest drops. Okay, and then we're also seeing tightening credit conditions that we've talked about, right? So that SLOOS survey, Senior Loan Officer Opinion Survey, showed that large banks are tightening their lending to small firms, and that is obviously down to levels consistent with prior recessions. Okay, so all these factors weighing on households, what they're spending, and what business confidence is, and what businesses are spending, right? And these are all leading indicators to why we are very likely to fall into a recession by later on this year, I would have thought, right? Q4, maybe probably the latest Q4, Q1 next year, but it may well happen by Q3. So just kind of watch out for that. Even though the kind of coincident data is coming in maybe better than expected, the leading data does not look good. Okay. Now looking at bonds, in recent weeks, yields obviously have been pushing higher. We've seen quite a reasonable push higher across the curve, as you had more resilient, like I said, more resilient US economic data in terms of right now. Concerns also about the debt issuance post the debt ceiling have weighed on the bond market. But if we look back at 2011, last time the debt ceiling issue happened, we can see that once the debt ceiling was actually passed, you had a big move down in yields, right? So 30-year yields were down 60, 10-year were down 70. This was basically in the following 2 weeks. 5-year were down 43 basis points, and 2 years were down 16. Now, clearly this was due to the fact that the US got downgraded. US debt got downgraded by S&P, and markets got spooked, and the flight to quality bid took those yields down. Okay, but the truth is, we've also got a recession staring us in the face as well, right? So whilst you've got this nervousness on issuance, that once that's played out, the next thing the market needs to look towards is the recession, and that may provide a similar dynamic in treasury yields to what we saw in 2011. Okay, so, and certainly in the back end, right? The question is, what duration are they going to issue to recoup that TGA, that Treasury General Account? I don't think they're going to go out to 30 years, right? Or even 10 years necessarily, right? So the point being is the long end of the bond market should be better supported by the fact that we can say with quite a lot of confidence that the recession is coming. Okay, looking at TLT, what are the big levels? So you've got 99.5 is a big support level. It's held a couple of times. If it breaks, it does open up this low that we got to last October in the kind of low 90s. So that might be one final push lower than it needs, but this is a level already around here near 100 where it may well bounce from. On the top side, 110 has been a big resistance level. If that was to break, then 120 would be your next target, right? So just give you a feel. And looking at the move index, you can see here that whilst we've been revisiting this downside support, we've seen no real uptick in the move index. So the move index has been kind of range bound here, okay? So that's interesting, because if the market was really concerned about bonds melting down from here and breaking these support levels, you'd expect there to be a bid coming back for rates vol, and we're not really seeing that. So that kind of makes us a little bit more comfortable. Remember how when we were talking about natural gas, and natural gas was making lower lows, but vols weren't reacting, and that was making us think that a decent bounce was coming. Well, we're seeing similar price action here, where we're heading towards key supports in bonds, but bond vol isn't picking up, right? And so that makes me think maybe a bounce is actually not too far away here. Okay. And also you had a 2-year bond auction yesterday, treasury auction, that was spectacular, right? So you had arguably the best 2-year auction in ages. And that again makes us feel maybe this move in yields has kind of got a little bit too far now, as people are stepping in and a bit more comfortable to buy bonds given the economic outlook. Okay. Now looking at our dashboard on TLT, we obviously see it in buy call territory here. Now we look at vol carry as well. That's in the 90th percentile, so not really amazing to just buy outright options here. Clearly, it's been in positive carry for a while, so we're not just going to go out and buy a load of calls. And also, because the timing of the recession is so hard to call, and we may need to buy a bit more time, we want to go further out the curve. So instead of buying short-dated stuff, we're going to go to the back end of the curve, and we're going to basically use the fact that skew is quite flat around here to do call spreads to kind of give us something that doesn't decay too badly. Even though the vol is relatively cheap, we don't need to buy a load of Vega, right? The trade is more a delta trade to kind of try and play a rally back in bonds by the end of the year. So we're thinking December expiry is where we want to park ourselves. We want to do it via call spreads. And we showed you the levels that we thought made sense. If 110 breaks, then 120 is the target. So we're going to go for a 110, 120 call spread in December on TLT. All right, that's it for today. Thanks a lot for listening. I'll catch you all tomorrow. Cheers.